webinars. However, it is devoted to a very important technical topic with global implications for financial stability. With COVID-19 consuming our attention for the past few months, most of us almost forgot about the 2008 global financial crisis. In the aftermath of the global financial crisis, the G20 endorsed a number of pivotal reforms intended to make the financial system safer. A core element of these reforms are policies that are addressing the too big to fail reforms in order to reduce moral hazard and systemic risk. The Financial Stability Board has been evaluating these reforms, and as a result, the FSB published a report for consultation on 28th of June. Today, we are delighted to host Claudia Buch to talk about the main findings of the working group and issues to be addressed in the consultation report. You have received her bio, so I will just very briefly introduce her. Claudia is Vice President of Deutsche Bundesbank and the Chair of the Evaluation of Too Big to Fail Reforms Working Group. She also has a distinguished academic career. Before I pass this over to Claudia, I want to thank our funders: Global Affairs Canada, the Swedish SIDA, International Monetary Fund, Jersey Overseas Aid and Comic Relief, and USAID, without whom we couldn't achieve our global mission. We have a great discussion ahead of us and look forward to your questions. Please use the Q&A tab to submit your questions during Claudia's presentation. It is now my pleasure to hand over the session to Claudia for her presentation. Enjoy the session. Over to you, Claudia.
Thank you very much, Demet. It's a pleasure to be here, although I'm not sure what here means. We're all in different locations. It seems that Toronto at this time of the year would be a very nice location to visit, but I'm in Frankfurt and I'm very happy to be here, and also the virtual meeting format makes it possible for all of us to meet. And I noticed that listeners are across the globe, so I'm very happy also to get your feedback on what I'm going to talk about, which is the evaluation of too big to fail reforms. And let me now try to master the first challenge, namely to share my screen so that you can actually see the presentation. Okay, is that working? Yes. Okay, so what I would like to talk about today is the evaluation of too big to fail reforms. And I think you're all aware of what it means. What is the too big to fail problem? It's basically about the issue that banks can become so large, so complex, so interconnected that their failure would cause harm to the financial system and to the economy. And so because this problem exists, a lot of reforms have been implemented, like Demet said, over the past 10 years to reduce the cost and the probability of financial crisis. So we have higher capital requirements for banks as a whole, and in particular for the larger banks and for the more systemically important banks, enhanced supervision, comprehensive resolution regimes. And basically these too big to fail reforms are supposed to address the systemic risk and the moral hazard associated with these banks. Before going into the details of what this evaluation has done, and I should say, I'm just speaking on behalf of a whole team, a very dedicated team in the FSB, across the FSB countries that has done this evaluation. And a lot of time and effort went into it starting early last year. So, and this is basically, this evaluation is part of a big project of the FSB evaluating the post-crisis financial reform. So as you know, these reforms have been agreed, the large body of it in 2009, so right after the global financial crisis. Then it took some time to actually implement, to design the reforms. So many of the too big to fail reforms actually became effective in 2015, for instance, with additional loss absorbing capital. And then the FSB said, well, the G20 leaders said, well, we have to also find a way to look at the effects of these reforms. So to actually have a framework of how we want to assess whether the reforms have reached their objectives, and how can we look at this. So there was a series of evaluations starting in 2017 on derivatives clearing, infrastructure finance, SME finance. So I'm sure also very relevant topics for people around this table here. But what I want to talk about is the too big to fail evaluation, as I said, which started the beginning of last year, and the final report is due early next year. And now we're kind of in a very interesting phase because we have the results. I noticed that this webinar is actually on the pandemic, so I must say, hope I'm not disappointing anybody, that our evaluation stopped prior to the pandemic. So we haven't taken the full effect of the pandemic into account, but we thought that we have interesting insights which are also relevant for this phase. And now it's the time for everybody to give feedback and to tell us what we have done, where we could improve our work. And that will, all that feedback during the consultation will also be part of the final report that we'll submit early next year. So that's why it's interesting for us to get feedback from all of you, from all interested stakeholders. But let me say a bit more how we're trying to tackle this issue, that actually the objectives of the reforms, namely to reduce systemic risk, to reduce moral hazard, these are things we can't observe. So there's no indicator. We can't go out and say, let's look at an indicator of moral hazard. All this is very indirect. And this chart basically shows how we're thinking about the problem. And let's start with the left-hand side, the choices of banks. So obviously bank managers, owners take a lot of choices, and some of these choices are affecting systemic risk. So the probability that a bank becomes distressed, and then also the capital shortfall given that the bank is distressed. And this then, in case that happens, in case the crisis happens or distress situation happens in the individual bank, governments have to choose. So they have to choose between bailout. So that was very often the route taken in the global financial crisis, because there was no framework for dealing with larger systemically important distressed banks, or resolution. And clearly what the reforms are trying is to tilt the balance towards not bail out, but bail in, choosing resolution options and managing distressed banks. So this choice of governments then in turn has implications for market perceptions of what we call implicit funding subsidies. So the more likely is a bailout, the higher is the implicit funding subsidy that systemic banks are enjoying. And then this is a mechanism that would be relevant at the national level and in basically all countries. But then the question is, of course, what are the effects on other countries, other markets? And that's a perspective that the FSB is taking. So what are the cross-border implications of all this? And this basically tells you how we've been looking at the too big to fail problem, how we've tried to assess the impact of the reforms, namely to see whether we do see changes in what banks are doing, whether we do see changes in the risk of the financial system, whether governments now have more tools to deal with distressed banks, and whether this is actually leading to changes in market perceptions. Before giving you the three main takeaways of the evaluation, let me also stress that usually you think about too big to fail as being about the globally systemically important banks. But as you see in this chart, and this is the basically the G20 countries, many countries have few or even none globally systemically important banks, but there are many, many domestic systemically important banks. And they're also part of this evaluation. I'll come back to that because we know less about these banks in an international context than we know about the so-called GSIBs. But just to be aware, this is not just about the GSIBs, but it's also about smaller banks, which is still very relevant at the national level. So what are the key findings? There are three of them. So the first is that these indicators that I've talked about systemic risk and moral hazard are really moving into the right direction. And it already tells you a bit the second finding, namely that effective too big to fail reforms actually bring net benefits to society. But we also find, of course, this sounds very positive. It sounds like we are there and nothing remains to be done. But this is actually not the case. So we also find that there are gaps that still need to be addressed. For example, improving the resolvability of financial institutions. We found a lot of information and data gaps. I'll come back to that. So the first finding, these indicators of systemic risk and moral hazard. Why are we saying that they have improved? Well, the first is, and there's actually, it's a very easy to visualize graph. These are the capital ratios of globally systemically important banks, and they have increased. So that's clearly beneficial. This is also has helped us, I think, tremendously in the pandemic situation, because there were buffers in the system that the banks could use to buffer shocks in the system. So that's clearly a positive finding. And that actually in and of itself implies that profitability of the systemically important banks has fallen relative to that of other banks. And you very often hear the banks complain, maybe the owners of the banks complain that profitability has declined, but we are actually saying that this is positive from the point of view of society as a whole, because higher capital means that return on equity declines. The reforms have also incentivized the banks to take on lower risk. We have higher funding costs because of the internalization of this implicit funding subsidy. So all this leads to a decline in profitability, which may well be in line with a stronger resilience of the financial system, of the banking system. So all this is clearly positive. And the third finding here is that lending has not declined. So many people fear that, well, if you increase capital requirements, in particular in the short run, that may mean that lending would decline. We haven't found that. We actually also haven't found that there are any other significant changes in the balance sheet structure of the systemically important banks compared to other banks. So maybe our measurement is not fine enough. Maybe that hasn't actually happened. But also we find that the complexity of global banks remains quite high. In terms of choices of governments, so failure of large banks has become less likely, but should it happen, what can governments do, or rather resolution authorities, what can they do? Clearly, implementation of resolution reforms has made progress. So we've actually constructed a resolution reform index going through a lot of FSB documents, national documentation. We've asked our members, and what we came up with is a resolution reform index that you see here on the left-hand side. And it basically gives you the legal implementation of resolution reforms following the FSB key attributes for resolution systems. And you see that there's been a gradual improvement. So there's much better systems now for the resolution and restructuring of distressed banks. So that's clearly positive news. It's on the legal side. So we have these institutions, we have the legal frameworks. And then, of course, the question is, to what extent is it actually implemented? Are these reforms used? Is it credible? I'll come to that in a second. What we also find is that total loss absorbing capacity has increased, and that's usually the acronym TLAC is important here. So what TLAC basically is that on top of the capital that the banks have, the equity capital, there's a tier of debt that the banks have issued that can be bailed in case of distress. And the GSIBs have to meet the final TLAC requirements by the end of 2022, and most banks already meet these final TLAC requirements. That's certainly good news. It's of course also reflecting that for most of the time period we're looking at here, there's been a very benign market environment, so the issuance was relatively smooth during this period. So that's good news in terms of feasibility of resolution. Is this considered to be credible? That's obviously a key question here. And what we do find is that, yes, implicit funding subsidies have declined. So you can see this here. When you look at what we're doing here in this chart is we are comparing the funding costs of systemically important banks to those of other large non-bank institutions, corporates, to other non-bank financial institutions. And no matter which metric you use or which comparison group you use, you see that if you look at the post-reform period versus the period kind of in between the crisis and prior to the implementation of the reforms, so the third part of this chart versus the middle part, then you see that these funding costs have fallen. So that's good news in the sense that implicit funding subsidies are lower now than they were prior to the reforms. But you also notice that in the crisis, in the pre-crisis period, we also had, or we are not necessarily below the pre-crisis period, to put it this way. So there's a reform effect, but comparing it to longer time series, there's not a big change. And I don't want to go into much detail here, but we also have a lot of indicators that market discipline has improved, so that markets are linking these funding subsidies more than they did prior to the reforms to the actually underlying risk of the financial institutions. So all of this is actually also good news from the point of view of whether the reforms are working. The second point, or the second key finding, the benefits to society. And there's obviously different ways of looking at the costs and benefits of these reforms. There's kind of this private view, the private perspective. So what would an individual bank, an owner of the bank, say? And obviously what I've just been talking about, the reduction in implicit funding cost subsidies, that actually means higher funding costs for the individual banks. So the banks may say, well, this is not our ideal world. We were better off in a situation with lower funding costs. But of course, we have to take the point of view of social costs and benefits. And what matters there is how likely is a bank to fail, how big is the potential loss to the taxpayer. So these are the social benefits you see here on the right-hand side. But also from the social perspective, there might be costs. So we might see a decline in lending. We might see, if the banks pass through higher funding costs to their customers, we might see higher borrowing costs. So we try to look at this in very different ways. And what we basically find is, and I make this very short, the social benefits are higher. So for the sake of time, I won't go into the details of how we look at this. But this is actually positive news, again, from the point of view, is it beneficial or not? There's a lot of detail on this in the report. Let me just mention one aspect here. Clearly, lending hasn't declined, so we don't see that the ratio of credit to GDP has fallen. What we do see is that there's been a shift in market share. So you can see this in this chart here. So the systemically important banks, they have reduced their market shares, but there's other institutions that have come in. So that's the yellow line here in the left-hand panel. So there you see that, of course, market shares change only slowly over time. So you don't see big jumps in this time series. But if anything, then the GSIBs and DSIBs, they have done less lending, and and other financial institutions and other banks have come in. So does it mean, as I said before, that we are there, that there's nothing that needs to be done, and that we can just lay back and enjoy the benefits of the reforms? Well, that's not quite the message of this report. So there are actually three main gaps that we think still need to be addressed. So one is that there are still, even given what I've said about the improvement in resolution reforms, there's still obstacles to resolution that can be reduced further. So we have seen, even in the period under investigation, that there's been some state support for failing banks. Resolution of central counterparty is also a key part of the FSB reform agenda, is still work in progress. And there's lots of, let me for now say, details in terms of resolvability that we still need to work on, and the FSB does do a lot of work. Information can be improved. So just to give one example, I've told you that we have more TLACs, so more bail-in capital in the banks now. We found it somewhat difficult to find out who are the holders of this TLAC debt issuance. So, and that's of course important for the resolution authorities to decide whether or not they want to use the bail-in option, and in order to understand what are the implications for the markets. And we think that actually all stakeholders would benefit from closing such information gaps. And then monitoring can be enhanced. So we know that with every regulation, there's effects on other market participants. So risks have shifted from banks to non-bank financials. Of course, we need to monitor this. We found it relatively difficult to get consistent information on these DSIBs, the domestically systemically important banks across countries. So there's also work that needs to continue here. I'm sure people around this virtual table may have more ideas, have comments on the report, and you may also have comments on whether we actually draw the right inferences about what we've observed here. And there's opportunity to give feedback to the FSB. You see the email address at the bottom of this page until the end of September. So I hope that people have many other plans for the summer, but I hope that some find also time to look into this and give feedback on the evaluation. And let me stop here and try to close the screen, and I look forward to this discussion. Thank you very much.
Thank you very much, Claudia. That was very brief and excellent presentation. Thank you so much. So we have some questions that I would like to pose. And so first, I would like to start the pre-submitted question because we received it a couple of days ago. It's from our participant from Botswana. For a small economy like Botswana, where all the operating banks are subsidiaries of international banks, is the principle of too big to fail appropriate? And it continues, in principle, isn't it important that supervisory authority should manage the exit of any bank regardless of its size?
Thank you. That's a great question, and it made me wonder, or it made me think that I actually know very little about Botswana, not only about the banking system, but also about the country. So my apologies if I can't say anything specific about the country. But I think the question that you raise is really, it's very representative for a lot of countries where that may have a relatively small domestic banking system where there's activity of some internationally active banks. And I would say that that's actually this whole issue of too big to fail is crucially important for countries like I try to portray Botswana without knowing the details in the following sense. So one is also domestically, there are banks that can be too big to fail for the individual country, that have a high market share, that can impose risks for the domestic financial system, for the domestic taxpayer. So I think a lot of the issues that are part of the FSB attributes of how to deal with failing banks can be actually relevant for every country, even if from an international perspective we would say, well, the banks in this country are not significant enough for the global financial system, or there's not much cross-border activity. So I think it's useful for all countries to consider, what does my local market structure look like, and what are issues if a large player in this market fails or is distressed. So that's one part of the answer. The second part of the answer is that I think precisely because smaller emerging markets, countries that are less maybe at the focus of the FSB, precisely because there's global banks being active in these markets, it's very important that we have good resilience standards for the globally active banks, because it might be very, the activity of an affiliate of a global systemically important bank in a smaller country may not be very important from the point of view of that large bank, but it might be very important from the point of view of that country. So that country wants to make sure that there's an international coordination, that the global banks that are active in emerging markets, that they're sufficiently resilient, that there's a mechanism for dealing with the failure of these banks. And we've actually seen many initiatives. There was, for instance, in the global financial crisis, there was the Vienna initiative in Europe, precisely in order to coordinate the activities of global banks so that they don't all of a sudden exit smaller markets with very high costs for these economies. So I hope that answers the question. There was also a second part of the question. Is that right about the? Could you repeat? so this managed. So was it also part of that question, the managing the exit of a bank regardless of size? Yeah. Okay. Yeah. So then, if I understand that question correctly, I think that, I mean, in some sense, banks are different from other companies, non-financial firms, in the sense that it's not that easy to just send a bank into insolvency. So there's differences in terms of how to deal with a distressed bank in compared to a distressed non-financial. But at the same time, there needs to be a mechanism for exit, like in any other market. And so the problem is that for smaller banks, it's sometimes easier to kind of merge them with other institutions. We've actually seen, I can just speak about my own country because that's what I know best. We've seen that many very small banks have left the market. They've merged with other banks. So I think for the smaller banks that are less systemically relevant, we do have mechanisms of dealing with these banks, and sometimes they're very institution specific. But I think it's also important to consider what's happening with the larger banks and how to organize exit or the restructuring of larger banks that have lost business models. So in that sense, I think it's important that we have normal market mechanisms functioning also for banks, but how exactly this operates differs between smaller and larger banks. Let me stop here.
Thank you very much, Claudia. So we have a lot of questions coming up. So there's one general question again. I would like to start with that. What is your opinion on over-regulation or the timing of implementation of regulations or policies and their impact on systemically important banks?
Well, first of all, I think partly I've answered that question in saying that we are now being globally in a very distressed situation, but not really first and foremost for the financial sector, but for the real economy. We're really seeing the benefit of having implemented the post-crisis reforms. So I think it's really important that we've done these reforms, that we have more, that we have a higher resilience in the financial system. So I think it's really important going forward to maintain that momentum and not to roll back reforms. So I think that's the first part of the answer. At the same time, of course, we need to be aware that whenever you increase capital requirements, there's the risk of deleveraging, because of course the banks need time to comply with the new rules. So that's why I think the regulators have been very careful to give sufficient lead time to have a time period until full implementation is required. So we always have to balance these longer term benefits versus the potentially short term costs. But what we find here is that the long-term benefits are clearly there, and we also don't really find much evidence about these short-term costs and short-term credit losses in credit, for example.
Thank you, Claudia. You mentioned in your presentation about this assessment being pre-COVID-19. So there are some related questions to that. For example, very interesting report and excellent presentation. Many thanks. You mentioned the timing of the report pre-pandemic. Will your group try to take account of pandemic-related developments that could affect the too big to fail question? Mm-hmm. Also, there is a related question to that saying if too big to fail reforms successfully helped authorities in preventing the bigger financial crisis due to, COVID-19. Mm-hmm.
Yeah, excellent question. So far, in terms of the analytical work, we haven't taken the COVID period into account, simply because, we would be also running after the fact a little bit, and it's hard to kind of do the analytical work real time. So all of our analysis basically stops February, but that was actually according to plan. So that was there's a process in the FSB, and depending on when is the deadline for the final report. So we didn't change anything actually in our evaluation schedule, but we basically finished everything in February. So the two key lessons that we take from this evaluation for the crisis period are twofold. One I mentioned, namely the better resilience that we have in the system, so the banks are better able to buffer the shock. And the second takeaway from the evaluation is that nobody knows what's going to happen. We have an extreme degree of uncertainty. Nobody knows how the real economy will evolve and how effective all the measures that have been taken to protect the real economy will be. But should there be cases where authorities have to deal with distressed banks, they now have much more options of doing so. And we felt that this was also an important message to send, but the report doesn't take any stand here. So the report obviously can't say anything about optimal policies in certain circumstances in a particular country. So we're just saying there's higher resilience, there's more options now for the authorities, and that's basically what the report can say. We do think, though, that coming back to work in the fall and updating the studies there's some issues, maybe the implicit funding subsidies. That could be something where we do some updates prior to issuing the final report, but that hasn't been decided yet.
Okay, thank you, Claudia. Another question. Your group focused on GSIBs, risk-based capital ratios, but did you also look at their leverage ratios? Hasn't the progress in reducing leverage being slower for the big banks versus other banks?
Excellent question. And there was a small line in one of my slides where basically with that information, in terms of the levels of capital. So I talked about the changes in terms of the levels of capital. We do see that there's differences in the leverage of GSIBs relative to other banks. Of course, there's many potential explanations for that. It may well reflect the risk of these banks that is lower. So that's something that we still do see differences in the levels, but the trends are clear, and that's also basically that's part of the regulation that the systemically important banks have to have higher capital, and that the capital requirements have increased by more. I should say that we, in terms of, for many reasons, but mostly in terms of data, and also because many of the reforms that have been implemented largely in parallel. So there was a package of reforms, and we found it very difficult to get really very detailed information on how did the reforms impact individual banks at a specific point in time. So everything we are saying is really about the whole package of the reforms, rather than about what is the impact of an increase in the GSIB buffer, as it's called, versus a change in the leverage ratio. So in that sense, we can't really say anything about specific reforms. Also because some of the reforms I mentioned as intensified supervision are very qualitative. So it's hard to really measure intensified supervision. So we can say something about pre-post reforms, are the GSIBs different from, and also the DSIBs different from other banks, but then it's hard to really drill down any deeper.
Thank you very much. The following question is, thank you, Claudia, nicely done. If in the final analysis, there appears to be a need to make policy changes to, for example, capital rules, how would that work? Won't the industry try to use the consultative paper for lobbying purposes? How would the FSB respond?
I can speak for the FSB because that's a large body, and so it's a structure.
Let's say, in your opinion.
Yeah, no, that's fine. No, I mean, so when we're saying that there are gaps that need to be closed, we are not really talking about redoing or rethinking the overall approach to regulation. So I think there's a very clear message that what has been done in terms of the overall package, capital requirements, supervision, resolution reforms, that's the right package. So there's nothing in the report saying, oh, this and that shouldn't have been done or should have been done differently. But at the same time, I mean, in particular, the resolution reform. So this is really changing the institutional infrastructure of how to deal with failing banks. So, and we have a relatively short time period where we are learning how the new system is working. So you should see these gaps in that sense. We are learning how the system is working, and we're also learning where there are gaps, but within the structure, the overall structure of the reforms that have been agreed upon. So I don't think the report can be read as saying we should relax regulation or we should do different regulations. But yeah, whatever. I mean, stakeholders may view it differently, but this is my expectation that it's clearly not saying that we should roll back the reforms or do things entirely differently.
Thank you. Thanks so much for your clear and precise presentation. Could you tell us how Basel Committee and Financial Stability Board will work closely to include this new regulation in the Basel principles?
Yeah, so we've actually worked very closely with the Basel Committee. So there was a subgroup doing related work on DSIPs and GSIPs and the buffers. So there was very good cooperation. And I should say that anything the FSB is doing here, like I said before, so there's no recommendations for policy changes. So basically, all the relevant bodies, all the relevant standard setters can now take the report, look at it, go through it, and see whether there's any need for changes. But then those changes should be discussed in the Basel Committee or in the respective bodies. It's not only the Basel Committee. So very close cooperation, but no, I mean, we wouldn't interfere with the responsibilities of other committees. And I think there's a very good division of labor here.
Thank you. So there's another one. You make a very good point about supervision and the more qualitative aspects of financial sector oversight. Sorry if you already mentioned this, but has the report also looked at more intensive supervision, and could there be any recommendations in that regard?
Yeah, no, I haven't mentioned it in detail, just a little bit in passing. So the short answer is no, in the following sense, that we did not have for specific countries or even for specific banks information on how supervision has changed. So you all know that there's new principles for intensified supervision, and there's also been a discussion. The FSB has worked with many other bodies on how to improve this, how to make this operational, but we didn't have any information. I think nobody has. So, but whoever knows may correct me if I'm wrong. I don't think there's really a good database. So I've not talked about the analytics a lot here, but what we need in order to really look at specific effects of reforms requires some quantification of the reforms, like we've tried to do with the Resolution Reform Index, and we don't have a similar database for improvements in supervision. And I think that would maybe also be stretching quantitative analytical work a little bit too much. But of course, there's a lot of other work ongoing, and we're citing this, and that qualitative work complements what we are doing here. But we are just looking at all this as a package, if you want.
Thank you, Claudia. Two questions from the same participant, Fiona. So I just combined those. Considering that during the pandemic bailouts are still needed, is this contradict with the ultimate objective of too big to fail reforms? And also she's asking, do you consider this pandemic has revealed any weaknesses of too big to fail reforms that the report has not covered? It was pre-pandemic, but what is your general view on that? Thank you.
Yeah. So there were two questions. The first was about we have seen, even in the past years, or let's say since the global financial crisis, we have seen cases where public money, taxpayers' money has been used also to bail out or partially bail out financial institutions. And this is often held against the overall, let me call it, philosophical approach of these resolution reforms that the FSB and many national authorities have followed. And I think that's, to some extent, it's not, well, I wouldn't say it's unfair, but it's really trying to measure where we are against the perfect benchmark. And what you have to take into consideration is that these reforms have taken time to be implemented. So the final decisions on, for instance, TLAC were taken in 2015. So this is not a long time when you think about structural changes in the financial system. So some of these cases that we have seen were very rather specific idiosyncratic cases. There weren't actually too many of those cases after the implementation of the reform. So some already happened a bit earlier. So I would hesitate to say, oh, because we have seen these isolated idiosyncratic cases, this is telling us that the whole reforms are not working. So what I find more plausible is to say, well, let's try to see how the reforms have been impacting all the GSIPs, all the DSIPs as a going concern, because resolution reform, of course, is relevant once a bank is in distress, but is even more relevant when during the going concern in terms of setting the right incentives and making sure that banks don't engage in too much risk taking. And that's where we have much more evidence across a broader range of countries. And that's where we've actually seen effects of the reforms. And of course, we can try and learn from individual cases, see to what extent they're representative for the system as a whole. The second part of the question, does the pandemic reveal any fault lines? That's how I understood it. So do we learn through the pandemic that there's things that we are missing and that we should have done? I would hesitate to make such a statement, because we're still trying to understand the pandemic, the impact on the real economy. We're still trying to understand the effects of all the fiscal and monetary policy measures that have been taken in order to shield the real economy from the effects of the pandemic. So, and I actually also doubt that we can draw these lessons until early next year. So I think our plan is to finalize the report and then see whether there's anything that we still need to look into. Maybe that's for the next project.
Okay, great. So another question, will it be possible to factor into your analysis the official sector measures taken by European Central Bank, Federal Reserve, Bank of England, and others to provide stability? Haven't these measures also helped the GSIPs?
Yeah, I mean, from an analytical point of view, clearly we can use basically all the analytical work that we have done, and I actually haven't explained much what we have done. So there's a lot of detail in the report. So basically, for those familiar with the literature, take for example the literature on implicit funding subsidies. So we basically look first of all, what is available in the literature? Are there analytical approaches that are useful for us? And then we've replicated some of these studies because we found that a lot of evidence is not available for all the countries that we're interested in. And I think it would be straightforward from an analytical point of view to, again, take these studies and say, now let's not look at the impact of resolution reforms, but let's factor in other macroeconomic developments like the policies that people have mentioned, fiscal policies, monetary policies. So that can be done. We are very transparent about the analytical tools we're using. There's a long technical appendix. We're citing the studies. Is this something that we are planning to do within the time frame that we have? I guess not. I haven't discussed with my team, but there will be another big effort to really go, really update all these studies, taking into consideration the effects of these other policies. So it's nothing. It's also not in the more technically speaking, it's not in the mandate of this group to look at all this, but the analytical approaches, I'm sure people would find good ways of actually integrating also these other policy measures. Yes.
Thank you, Claudia. I see many questions related to pandemic effects, so maybe it's another, webinar series to look at this issue. There's another different question. Do you think there is any hope of creating a global regulatory derivatives trade repository available to all G20 prudential central bank and securities authorities?
That's a very specific question. Yeah. So is this about the data, trade repository data? So it's the derivatives traded on CCPs? Is that the idea?
Yeah, I think that's what is meant. Not clear, but yeah.
Yeah. So well, we have made a lot of effort also to get better data on trade repositories, and I know there's a lot of projects here in Europe, and my colleagues here in the Bundesbank are also working with those data in the statistical community. There's also a lot of work on how, I know that individual countries have collected that data, so I think there's a lot of learning, information sharing, how to use this trade repository data. I must say that I'm not aware of initiatives to combine all this into one major database, so it seems a daunting task. I don't know. So I think at the current juncture, we're trying to use and learn how to use the information that we have available, and maybe there's a good. It's less about integrating everything into one database, but learning how to use these databases, sharing experience. So maybe that's the more promising route to take.
Thank you. I also see some questions in the chat box, so I'm going to pick one of those. Is there as well progress towards a level playing field? In other words, are all countries addressing the too big to fail issue appropriately, or which countries need to do more? Perhaps we cannot mention the names of the countries, but I'll leave it to you.
Yeah, no, I mean, so I can't name countries. I mean, that's actually also not the purpose of this type of evaluation work. So as you know, the FSB is also doing peer reviews where they engage very closely with national authorities. So that's, I think, the forum or the channel through which this kind of country-specific recommendations should be conveyed. So what we are doing here, so you can look at the data. Let me take this resolution reform index. The information on the resolution reform index is in the appendix of the report. You can actually download from the FSB website. You do see differences in implementation across countries, and that's what the report is saying, that these gaps between full implementation and where the countries are right now, these gaps should be closed. So that's one of the things that I mentioned earlier. We very well understand that it can be very difficult politically to implement these reforms. So I wouldn't, even for the countries where you see a gap, I wouldn't see that they haven't made enough effort, but it may just be very difficult also nationally. But of course, we should all aim at following the same same standard and the same principle. So this is what the FSB work is about. Does that necessarily mean all countries have to do exactly the same thing? So that's sometimes what you hear, that we're only living in a well-regulated global financial system if everybody's doing the same. Well, not necessarily. So there might be important country-specific features that you have to take into consideration when designing regulation. And I think this is not where international bodies can say a lot, but it's important that wherever cross-border effects are relevant, where there's externalities, that we then follow a same coordinated approach to make sure, coming back to the first question, to make sure that also smaller countries, emerging markets can rely on a coordinated global system. I think that's very important. So coordination where it's needed and appropriate, but national approaches wherever there's need for it.
Thank you, Claudia. So another question for you. To what extent does the concept of too big to fail and emerging reforms apply to other financial institutions such as the insurance and capital market sector or group?
Yeah, so not the focus of this evaluation, obviously. There's a lot of discussion to what extent can other institutions also be too big to fail. I think there are two answers to this question. One is, of course, banks and insurance companies. To give that example, they have different business models. So when you do classification of banks as being systemically important, that would be different for insurance companies. So I think it's important to take these differences into consideration. Clearly, there's one set of institutions, the CCPs, the central counterparties, that are to some extent systemically important by definition, because we want derivatives to be traded on central platforms and not just over the counter where it's very difficult to supervise and to monitor. So this is why the report is saying that in particular for these central counterparties, we also have to make progress with defining resolution systems, implementing resolution reform. So that's one of the areas where we see need for action also.
Okay, thank you very much. I have a kind of follow-up question. What happens? What is the next steps in terms of after what happens after September 30th when you receive all those comments, feedback from the your audience?
Okay, well then we first of all we come back from the summer break. We're all relaxed and eager to do more work. So we will look at all these. So first of all, we have maybe that's interesting. We also do a lot of outreach, like this type of event, but we also organize workshops with stakeholders. So we will have another workshop with stakeholders also to get feedback from them, having discussions of the report. So that will be in early September. Then we can all come back from our summer holiday. We will look at this feedback. Actually, the feedback will also be posted on the FSB website. So whoever wants to see it, read it, can do so. We will go through it. We will see to what extent there's feedback that we need to take into consideration when drafting the final report. To what extent there's additional sources we have to cite, and there might be very targeted updates of the analytical work, like I mentioned earlier. So we haven't discussed exactly what this will be, and we have to finish that also in the third, fourth quarter of this year. So that gives a somewhat limited time frame. So there will be targeted updates and just seeing where we've misrepresented some evidence. So there's actually a whole set of consultation questions, which kind of gives you the type of information we would want to have to improve the report and to publish the final report.
Sounds like you have a lot of work to do in the incoming months or perhaps a year or so. It's really must be very hard to assess the impact of such reports, to evaluate those. And big congratulations to the FSB team and your working group. I have a different question as a closing. I know you are very busy, so we won't take your time. I apologize for the rest of the participants. We won't be able to answer all the questions, but I appreciate their enthusiasm and joining us today. And this is totally different than our theme. So we don't really see many female leaders accomplish so much, and like yourself even in this century. So I was wondering, what piece of advice would you give to young women who are at the early stages of their careers?
Interesting question, very different from the too big to fail question. Yeah, so, well, to some extent, I think the advice I give to also in my previous life, working as an academic and having students, PhD students, I think the advice I gave was not that different for male and female students. So one of the first pieces of advice I always give is whatever you choose or whatever you do things that you enjoy. So I think trying to pursue a career for the sake of pursuing a career, I think that's never a very good choice. So do things that you actually enjoy and that where you feel like this is something I could do for the next 10 years and or maybe even longer. The second point is one shouldn't shy away from challenging tasks. So, and maybe that's I don't know if there's a gender balance or differences across gender types there, but I think very, very often you learn, that's what I've learned, that things that seemed like a very difficult or too complicated task, actually after doing it several times, it was actually easier. There was a learning effect. So I think that's important, try to put the bar maybe not too high that you can't cross it, but, be ambitious. So I think that's very important. And the third thing is work with others. So I think in particular in academia, where I'm coming from, there was for a very, very long time, cooperation interaction wasn't really much appreciated. I think this has also changed over time, and working with others, I think, has two beneficial effects. I think usually it's more fun, and that's important. So you should enjoy what you're doing, and it also helps you building networks and in interacting with others, learning to also how to make compromise. And I think that's very important if you want to make it wherever in academia or in a more policy-oriented organization like ours. So maybe these three pieces, and I think they hold across gender, but maybe they're particularly important for women in policy making or academia.
Thank you, Claudia. That was great advice. Very good. Also, just to attach to our theme today, too big to fail. Perhaps we cannot never, be scared of failing, I guess.
Yeah.
Keep moving, take your lesson. Thank you very much. It was great pleasure to having you today. We appreciate your time spending with us today, and thank you. Big thank you to our participants for their support. Hope to see you again in another Toronto Center event. Let's keep in touch, and thanks again. Bye, everyone.
Thanks for listening. Thank you. Bye-bye.
Thank you. Bye-bye.